Joining us now, Strategas Research Partners CEO Jason Trennert. Jason, great to have you with us.
Great to be here.
You say the market's overbought. Why is it overbought?
I think it's overbought mainly because of valuations. And, of course, markets can stay overbought a lot longer than they can stay oversold. Usually that resolves itself pretty quickly. But it's really hard, even if you look at the most optimistic expectations for earnings next year and you put a 20 multiple on that, you would say that the market is not particularly cheap. So, but valuation is not a particularly good timing tool. And, it seems like the path of least resistance for the market is higher from here.
So what would you say to investors? I mean, you say that markets can remain overbought for quite a long time. The risk rewards are dwindling at this point with markets where they are. So do you sit it out at this right now?
I certainly wouldn't put a lot of fresh money to work, and I wouldn't put a lot of fresh money to work in the parts of the market like tech and communications that have been up the most. I mean, I think you're not. I don't know if you're really getting paid for any sort of the potential risks there now. There does seem to be some rotation towards energy, some of the financials, which I think is good for the overall market. To me, those look, a lot more exciting or attractive just because they've sat out a good portion of this rally, at least this year.
Jason, you're not alone in terms of being less constructive on the market. There are quite a few strategists, I think, who've been somewhat surprised at the strength of this rally. But what, looking at this year at the beginning, what is it now, more than halfway through, that you sort of think, well, geez, I didn't anticipate that?
Yeah,
how does that color your view?
No, it's a great question. So, because we're actually doing those for tomorrow, it's two things I would say. One is that the profit margins have come down, but not enough to force companies to lay off workers as we thought. So you still have 10 million job openings out there. So the labor market's still tight as a drum. And even though there were some signs of claims moving up and all the rest of it, the labor market has come kind of roaring back. So that's one thing. The other thing I would mention is that, believe it or not, the S&P 500 was essentially flat the day before Silicon Valley Bank failed. It was up 58 basis points year to date at that point. At that point, the Fed stopped quantitative tightening. It actually added money to its balance sheet, and then you just took off. So that was kind of the pause. That was almost the deek, if you will, in the coverage where a lot of people kind of expected the market to slow down or fall, but that was actually just what the market needed, and the market hasn't looked back since. So those are two big things, I would say.
But not enough to push you off of where you stand, which I'm sure is hard when you're grinding higher as you do almost every day.
Yeah, sure. And again, you don't want to. Discretion is a better part of valor, right? I mean, you have to play the ball as it lies. Market's moving higher. I don't think there's a lot of value in the market at these levels, but you have to kind of take what the market gives you, and that's why I would say I'm looking at some of the other sectors that haven't participated as much in the rally for some opportunities. I think that's the way to play it.
Also, what happened at the beginning of the year is this whole AI theme that came about, which is theoretically accretive at some point during it. It puts out there a reason for growth for the tech stocks. And some of those tech stocks do not have stretched valuations compared to the market.
Well, it's, so if you talk about the Magnificent Seven, right?
Which I hate that term, Magnificent Seven, by the way.
Right. Well, it's.
You do?
I do.
It's a great movie,
We'll have to explore that. Maybe later in the show.
Well, it implies that that they are in fact great.
Yes, it does. They've been great.
They've been great. I mean,
what do you call them when they turn?
Yeah.
Anyway, go ahead.
But anyway, the thing.
Horrible Seven.
The horrible seven. Yeah, the good, the bad, and the ugly. I don't know. But listen, I think the thing about those companies, they're very cash rich, right? So there's an awful lot of companies in the NASDAQ, or a good portion of the Russell 2000, that hasn't had profits in the last 12 months. Those companies are still, in my opinion, very much at risk because the cost of capital is still quite high, right? Those companies are a little different because they have so much cash that you can, if things don't go so well, you can make your own luck. You can start buying back stock.
So you are in the big tech as defensive camp.
Yeah, I think it's turning out to be defensive. Now, again, would I put a lot more money to work in Google, Microsoft, NVIDIA at these levels? Probably not, but they are magnificent in that regard, right? So, and it doesn't leave a lot of room for error if you're wrong, but I certainly wouldn't short them.